What is a bear market? A market is said to be in a bear market when prices continue to drop over time. Typically, it refers to a scenario in which widespread pessimism and unfavorable investor sentiment cause securities values to decline by 20% or more from recent highs. Bear markets are frequently connected with drops in an entire market or index like the S&P 500, but individual stocks or commodities can also be categorized as being in a bear market if they suffer a decline of 20% or more over a prolonged period of time, usually 2 months or more. Bear markets can also occur in conjunction with broader economic downturns like a recession. Bull markets that are moving upward can be contrasted with bear markets. Phases of a bear market. There are typically 4 stages to a bear market. High pricing and positive investor optimism characterize the first phase. Investors start to withdraw their money from the markets and reap their profits as this phase comes to a close. The second stage is characterized by a dramatic decline in stock prices, a decline in trading activity and corporate earnings, and a decline in previously strong economic indices. As sentiment starts to decline, some investors start to panic. Capitulation is the term for this behavior. Speculators begin to enter the market in the third phase, which raises some prices and trading volume. Stock prices continue to decline in the fourth and final phase, although slowly. Bear markets begin to give way to bull markets when investors start to once again become attracted to low pricing and positive news. Bear market versus correction. A correction, which is a short-term trend with a length of less than 2 months, should not be confused with a bear market. Value investors can find a decent entry point into the stock market during corrections, but bear markets rarely give such opportunities. This barrier exists because it is so difficult to predict when a bear market will bottom out. Unless investors are short sellers or employ other tactics to earn gains in declining markets, trying to recover losses can be difficult. The Dow Jones Industrial Average, DJIA, saw 33 bear markets between 1900 and 2018, or 1 every 3 years on average. Between October 2007 and March 2009, the global financial crisis coincided with one of the most notable bear markets in recent memory. The Dow Jones Industrial Average, DJIA, fell 54% during that time. The most recent 2020 bear market for the S&P 500 and DJIA was brought on by the worldwide COVID-19 epidemic. In March 2022, on the back of worries over a war in Ukraine, economic sanctions against Russia, and high inflation, the Nasdaq Composite last experienced a bear market. Summary: a market enters a bear market when prices drop by more than 20%, sometimes accompanied by sour investor sentiment and dimming economic prospects. Bear markets can be short-term or cyclical. The latter can endure for several years or even decades, whereas the former only lasts for a few weeks or a few months. Investors can profit from falling prices during a bear market by engaging in short sales, buying put options, and using inverse exchange traded funds, ETFs. Thanks for watching. Don't forget to subscribe.